Today, we are going to perform surgery on one of the most agonizing decisions every Australian investor eventually faces. It is the fork in the road that determines whether you retire with a stressful mountain of debt or a passive income machine. Here is the scenario. You have finally secured a solid borrowing capacity. Maybe you have a budget of around $1.5 million to $2 million. The bank has given you the green light. Now you have a choice. Do you go all in on one trophy asset, a single expensive blue chip property? Or do you break that capital down and buy 2, 3, or maybe even 4 cheaper properties in different locations? It sounds like a simple question of quality versus quantity. But as we dig into the numbers today, you're going to see that the common wisdom on this is often dead wrong. I'm going to uncover the hidden costs, the cash flow traps, and the casino math that proves why bigger isn't always better. If you have ever wondered if you should buy the big house or build the portfolio, this episode is for you. Part 1. The allure of the big ticket purchase. Let's start with option 1, the single expensive property. Let's say you buy one house for $1.5 million. I understand the appeal. Psychologically, it feels safe. It feels prestigious. And there are some genuine logistical benefits to this strategy. First, there is transaction efficiency. When you buy property in Australia, you get hit with a laundry list of unrecoverable costs. Stamp duty, legal fees, loan application fees, building and pest inspections, and valuation fees. If you buy one property, you only pay these transaction costs once. It's a one-and-done event. Then, there is the management factor. If you're a lazy investor, and I don't use that word negatively, some people just want simplicity. Managing one property is undeniably easier than managing 3. You have one tenant to worry about, one hot water system that might break, one council rates bill. It is less mental bandwidth. And finally, there is the sheer scale of the capital growth numbers. This is what seduces people. If a $1.5 million property doubles in value over 10 years, which is the Australian dream, it becomes worth $3 million. That is a $1.5 million gain. It feels huge. It feels like you have won the lottery without doing any research. You just bought a nice house in a nice suburb and waited. For those looking for a get-rich-quick feeling, seeing that asset value tick up by huge amounts every year is addictive. And here is the massive but that nobody tells you at the open home. This strategy has hidden cracks. And if you aren't careful, you can fall right through them. Part 2. The hidden trap of the trophy home. Let's peel back the layers on that $1.5 million purchase. What are the downsides? The barrier to entry, the first hurdle, is the deposit. To buy a $1.5 million home, you typically need a 20% deposit to be safe, plus stamp duty. You're looking at needing around $300,000 to $400,000 in cold hard cash. For a young person or a couple trying to break into the market, saving $300,000 takes time. A lot of time. And while you're grinding away for 5 or 6 years to save that deposit, what is the market doing? It's rising. This is the opportunity cost of waiting. By the time you save the deposit for the $1.5 million house, it might cost $1.8 million. You're chasing a moving target. This is why people say buying a house is getting harder, because the goalposts keep moving while you save. The cash flow nightmare now, let's assume you buy it. You now have a massive mortgage, probably around $1.2 million. If this is your principal place of residence, you're in what I call mortgage prison. Let's run the math using a 6% interest rate. The interest alone is substantial. Adding council rates, water, insurance, and maintenance. You're looking at a holding cost of roughly $100,000 per year just to keep the property. Ask yourself, can you effortlessly spare $100,000 of post-tax money every year? That is a massive strain on your lifestyle. Even if it's an investment property, expensive homes typically have terrible rental yields. The rent won't cover the mortgage. You will be negatively geared, bleeding cash every month to keep the bank happy. And if you sell it later as an investment, you get hit with capital gains tax, further eroding that profit. The real return on investment, this is the calculation that shocks most people. Remember we said the house doubled to $3 million? You think you made $1.5 million profit. But did you? If you held that loan for 10 years at a 5% average interest rate, you paid the bank nearly $550,000 to $600,000 in interest. Plus repère. Your real profit is the capital gain minus the holding costs. Suddenly, that $1.5 million profit shrinks down to $950,000 or less. The bank took a huge chunk of your win. Risk concentration finally. You have put all your eggs in one basket. If you lose your job, or if that one property sits vacant for 3 months, you are in trouble. You have 100% of your debt tied to one income stream. If you're forced to sell in a bad market, you can't just sell a bathroom. You have to sell the whole house, potentially at a loss. Part 3. The volume strategy. Buying multiple cheaper properties. Now, let's look at the alternative. Instead of one $1.5 million giant, what if we bought 3 properties at $500,000 each? This is the path I personally prefer, and the path taken by many successful portfolio builders. Let's look at why. Speed to market. The most immediate benefit is speed. To buy a $500,000 property, you only need a $100,000 deposit. It is much easier to save $100,000 than $300,000. This means you can enter the market years earlier. You buy the first one now. You let it grow while you save for the second one. You aren't sitting on the sidelines watching prices rise. You're in the game. Cash flow, safety. Cheaper properties generally offer higher rental yields. A $500,000 house in a growth corridor might rent for $500 to $600 a week. If you have a mortgage on that property, the rent is doing the heavy lifting. At current interest rates, you might have to top it up by a few $1,000s a year, let's say $2,000. But compare that to the big house where you are topping it up by $100,000. And if interest rates drop back down to, say, 5%, these cheap properties often become cash flow neutral or even positive. They pay for themselves. You can hold them forever without stress. Risk diversification. By owning 3 properties, you are spreading your risk. If one tenant moves out, you still have 2 other tenants paying rent. You aren't exposed to a total income collapse. Furthermore, you could buy in different markets. Maybe one in Brisbane, one in Perth, one in a regional hub. If one city has a downturn, the others might be booming. You're hedging your bets against local economic cycles. And if you hit a financial crisis and need cash, you can sell one property. You keep the other 2. You retain your position in the market while solving your immediate cash flow problem. Scalability. This is the secret sauce. If you want to build a large portfolio, you need the bank to keep lending you money. When you buy the big $1.5 million PPOR, you max out your borrowing capacity with bad debt, which means the debt that doesn't produce income. The bank cuts you off. When you buy high-yield investment properties, the bank sees the rental income. They see that the asset is supporting itself. This often allows you to borrow more for the next property and the next. It allows you to build a machine rather than just buying a home. Part 4. Addressing the criticisms. Now, I can hear the skeptics. But if I buy 3 properties, don't I pay more fees? Yes. You're absolutely right. You will pay 3 sets of legal fees, 3 building inspections, 3 loan application fees, and managing them takes more effort. You will have 3 property managers to email, 3 tenants to manage, and 3 times the minor maintenance issues. But here is the reality check. If you are afraid of a little administration work, you shouldn't be a property investor. Investing is a business. Managing the managers is part of the job. The financial upside of a multi-million-dollar portfolio far outweighs the inconvenience of reading a few extra emails. Some people also think that cheap properties are junk assets that don't grow. This is a massive myth. Expensive properties do not automatically grow faster than cheap ones. In fact, affordable suburbs often outperform prestige suburbs in percentage terms because there is more demand pressure at the affordable end of the market. Long-term growth rates are often very similar, but the holding costs of the expensive property are what kill your final return. Part 5. The rent vesting solution. So, does this mean you have to live in a cheap house in the outer suburbs? Absolutely not. This brings us to a strategy mentioned in the text, rent vesting. You can have your cake and eat it too. You rent the $1.5 million home in a nice suburb where you want to live. Simultaneously, You use your capital to buy three $500,000 investment properties elsewhere. Why? Because renting a luxury home is almost always cheaper than owning it when you factor in interest and maintenance. You pay the cheaper rent to live in a lifestyle location, while your tenants pay off your high-growth assets in other areas. It is the ultimate arbitrage. You get the lifestyle without the mortgage prison, and you get the wealth creation without the cash flow stress. Part 6. The casino analogy. I want to leave you with an analogy that really drove this point home for me. It's a bit crude, but it works perfectly. Imagine you walk into a casino where the odds are actually in your favor, like the property market generally is long-term. Player, the big buyer walks up to the high-stakes table. They place one single bet of $1,500. If they win, they double their money to $3,000. But the casino takes a $500 fee, which is equivalent to those holding costs or interests from their winnings. And crucially, because they went all in on one bet, they have no chips left to play any other tables. Player B, the portfolio buyer, walks up to the smaller tables. They place 3 bets of $500 each. If they win, they also double their money. But at these tables, the casino fee is almost zero because the rent covers the costs. Even better, because they are winning at multiple tables, the casino manager offers them credit to place more bets. Player A wins once and pays a heavy price. Player B wins 3 times, keeps all the profit, and gets to keep playing. That is the difference. The expensive property limits your moves. The portfolio strategy gives you options. Part 7. The exit strategy, how to retire. So what is the end game? Why go through the hassle of buying 3, 4, or 10 properties? The goal is the exit strategy. Let's say you buy 8 to 10 cheaper properties over your career. In 15 years, they have doubled in value. You sell 3 or 4 of them. Yes, you pay capital gains tax, but you use the leftover profit to completely pay off the debt on the remaining 4 or 5 properties. Now, you are retired. You own 5 houses debt-free. If each one rents for $600 a week, that is $3,000 a week in passive income. That is a 6-figure salary for doing absolutely nothing. You cannot do that with one big house. You can't sell the kitchen of your family home to buy groceries. You're asset rich, but cash poor. The portfolio strategy is about creating income.